My guest today is Professor Antoinette Schoar, who is Professor of Finance at MIT Sloan School of Management. Her research interests span from entrepreneurial finance to household finance, fintech, cryptocurrencies, and financial intermediation. Welcome, Antoinette.
Thank you for having me.
Yeah, thanks for doing this. So we had some technical difficulties last time. So I'm happy that you could do this again. Um, so I got some of your papers. And I want to start with cryptocurrencies and decentralized finance, DeFi, you say here.
Mhm.
The paper provides an overview of cryptocurrencies and decentralized finance. The discussion lays out potential benefits and challenges of the new system and presents a comparison to the traditional system of financial intermediation. Our analysis highlights that while the DeFi architecture might have the potential to reduce transaction costs, similar to the traditional financial system, there are several layers where rents can accumulate due to endogenous constraints to competition. We show that the permissionless and pseudonymous design of DeFi generates challenges for enforcing tax compliance, anti money laundering laws, and preventing financial malfeasance. We highlight ways to regulate the DeFi system, which would preserve a majority of benefits of the underlying blockchain architecture, but support accountability and regulatory compliance. So we have some technical stuff here. Let me start at the foundation. What's the cryptocurrency?
What's a cryptocurrency? So you can think of it basically um, as a virtual token
Yeah,
that is created, on, the internet, if you want, or kind of
yeah,
in ether space. And what's special about cryptocurrencies is that they are trying to design a way of achieving consensus about the validity of certain type of of transactions
yeah,
without the backbone of the traditional, say, financial systems, traditional regulation. And the
mhm,
reason, so maybe to turn it around, right, is to say
yeah,
that, blockchain technology allows for consensus protocols
mhm,
that rely either on proof of work, like Bitcoin,
yeah,
or proof of stake, like, say, Ethereum now, right?
yeah,
But basically, you do not need a centralized financial institution, say like a bank or
mhm,
an exchange that keeps the ledger in a
yeah,
centralized place in order
mhm,
to keep track of whether you paid me or I paid you, right? And whether I
mhm,
still have balance in my account to pay for somebody
yeah.
else and so on.
But a lot of people are verifying it. So if you think about longitudinally, we start with bartering system, which is very difficult to implement. And then we moved into gold and silver with an expectation that those things, no asteroid will crash into the earth, with a hundred megatons of gold or whatever. But people didn't think about it. So gold and silver um, sort of expected to retain its value. It was difficult to carry. Those things are heavy. And then we had the paper currency. That was sort of getting a receipt from the government that I'll pay you this much money at some point in time. And with the paper currency thing, we have so we moved on to I guess we moved on to the bank intermediary system where you say, yeah, I pay you this, and I just put in a bank transaction. I don't see the money, but then it goes from one place to another. And this is sort of the culmination of that in the sense that cryptocurrency
Mhm.
allows us to, so we don't have to rely on, these big banks and providing, I mean, they make mistakes too, actually, in many
That's
cases. So this is, so explain a little bit about that sort of technical architecture
Yeah.
Why do cryptocurrencies give us a better security and a better way to transact?
So it's a very good question, but
Yeah.
I would maybe even frame it a bit more broadly, right? If you think about the people, or originally, the idea of cryptocurrencies, in particular, say, Bitcoin, Satoshi Nakamoto's idea, right, is this the concern that when you have a financial system where centralized players like banks and exchanges and so on carry a lot of weight, and they are the ones who are the ledger keepers, right? Because let's say when you are with a bank and you're sending money to somebody else, right, or receiving it, they keep the ledger for you and for all the transactions, right? That kind of account holders in the bank have. Now, the benefit of this is actually that it's very efficient, because if you trust your bank, right, you have one intermediary that, if it does a good job, right, it keeps all the transaction in the ledger safe. It does it in a very efficient way, and actually, as a how do you say, third benefit could be that actually privacy of you and me and everybody interacting with this bank could be very well protected if the bank does a good job, right? Because it's inside the bank. And so then outsiders do not see that. And so you see, but the concern has been that the last 2 points I was raising might not always be perfectly implemented by these big players, the banks. Because if you think about the last thing, right, it's true that we want banks, and we have so much regulation, right, in the traditional financial system, that the banks should protect our privacy so that there are no hacks, it doesn't leak, right? Whatever you do in your private life, you don't want to show up, online that, you bought some junk food once in a while, right? I mean, it might not be anything even bad, right? It's your privacy. And one concern is, however, that the bank itself might not have the same incentives to keep your transaction private as you would like them to have, right? And so maybe if regulation was to fail and the banks get hacked, right, we might not be protected. And so one objective of cryptocurrencies had been that, if we have this pseudonymous system where everybody is pseudonymous, and so you don't know their identity, right? Maybe that's more private. I will come back in a second to this, because actually in the end, we have seen that fails big time actually in cryptocurrencies, but we can get there, right? But the second objective had been, or if you want, the second very big criticism of the traditional financial system for a long time has, of course, been that when you give these central players so much power to be the ledger keepers, right, they might also abuse it, right, in the form
it's sort of monopoly power.
Absolutely, right? Or we like to say in economics, right, local monopoly power, because there are a few of them, but it's absolutely right. They can either charge you more than you would in a competitive world, but they might even do things like front-run transactions of some of their customers that they know are the most informed, right? All these things, of course, are very serious concerns when you give a lot of power to a few, kind of central intermediaries. And that's why we have so much regulation in finance, right? Because we want to make sure that, say, market makers and exchanges cannot just take the data they have and then say, ha, 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 right? We're going to front run any smart investor who tries to put in a trade on NYSE or NASDAQ, kind of we front run their information. But and of course, there have been infractions. A lot of research in finance is about how the idealized world of finance often breaks down, right? And how bad incentives actually then lead to problems. And so you see, there is, if you want, at its core, the objectives and the goals of cryptocurrency, of why, blockchain technology and cryptocurrencies could be useful, are very valid. And they actually, come from a place that I can completely understand. In fact, I'm as critical of traditional financial system as maybe many crypto enthusiasts, the problem that we try to point out in the paper is that, unfortunately, a naive belief in cryptocurrencies leads to a situation where crypto will have very similar, if not some worse outcomes than the traditional financial system.
Okay, so I want to learn a little bit about that. So privacy was a big concern, as you say. Security and trust. I mean, if you go with a really large bank, maybe trust issues have been, well, I mean, we went to 2008, so you can really have that as sort of a possible thing. But so there is a trust issue, there is a security issue, there's a privacy issue. So if I understand this correctly, Antoinette, I don't quite. So now we have, it's sort of making transactions democratized in the sense that there is no one big player. There's a large number of people who have to sort of sign off on a transaction, right? Is that what's happening?
So that's exactly, this is what the ideal world, let's, if we start with Bitcoin, which is obviously, if you want, the brainchild of this anonymous entity, Satoshi Nakamoto, right? But the idea had exactly been this, right? Which is that let's find a way of making the ledger where all transactions are recorded, let's make it basically open for everybody to access, right? But make it anonymous or pseudonymous, right? So that wallet A has paid to wallet B, and I can see that wallet A had the money to pay wallet B, right? And then it moves, right? But we don't know if it's me or you or what have you, right? And so people thought, that's a way of maintaining privacy. Yeah. Now, let me stop there and we go to the verification in a second. The reason why that's actually not a perfect way to protect privacy that now we have seen in over the last decade and more, right, in the crypto world, is that whenever you transact with somebody, you need to give them your address. Right. And so let's say if I want to send you money, I need to know the address I need to send it to. Right.
And the address is public.
Sorry. Right. Exactly. And kind of think about address here is what, in banking would be your account. Right. Like, or, but so then
it's a complex address. It's a hash.
Sure, it's address. It's a long string of numbers and letters and so on. Right. But still, as soon as you tell me, at least to me, you are not private anymore, right? And so now, and I'm just some random person, right? Imagine, and this actually, in my research, we have used this quite a bit. People go and say, I just talked to Gill and he bought some XYZ for me. And guess what? His address is this. Or, kind of, so maybe they didn't have bad intention. They just put it online, right? So, but, kind of, so there's a lot of, you see, or whenever anyone interacts with another entity, your address becomes public. Your address becomes public. And if now comes the biggest problem, which is basically as soon as one of your addresses on the blockchain becomes public, because everything is there forever, anyone, also a researcher like me, can go and see any transaction you have ever made. So you become completely not private, right?
Completely exposed. You have your name on it.
Exactly.
You have an address on it.
Exactly, right? And so I can, I have I have done a lot of work to trace different type of investors and entities on the blockchain to figure out, how this ecosystem works and the pricing behavior and so on. But as you obviously know very well, right? There are also professional companies now, basically, kind of crypto analytics company like Chain Analysis and many others, right? That do that tracing for a living. And so therefore, actually the privacy issue has already been broken on crypto, right?
Already
on the large cryptocurrency blockchain.
Not something the founder, I guess, thought about.
Yeah,
in some
but
ways.
maybe
Yeah.
didn't
Yeah.
expect it to be.
Yeah.
You see, I think the other thing, I actually believe, even though, who knows what the founder thought, right? But
Yes.
I think
Yeah.
really the idea was that the world would stay this decentralized world,
Yeah.
an idealized world. But what we have, for example, now also seen, and so this is my second point, right? The other idea that cryptocurrencies were trying to address is that, as we said, there are these big centralized players in the traditional finance world that
Yeah.
have this market power. Can we get rid of them?
Mm.
And the idea with crypto was, because everything is on the blockchain, everyone and everywhere in the world can access the
Mm.
blockchain. There will be more competition, and because there will be more competition, there will be no market power. But
Yeah.
the truth is, so there are two big logical mistakes when you make that point, even though it sounds maybe so nice when I say this, right? But
Yeah.
100 year of finance research tells you, without even looking at data, that this is wrong. And I tell you, there are two things that are
Mm.
wrong. One is, at
Yeah.
the market level, we know that financial markets are the poster child of endogenous creation of market power. Why?
Yeah.
Because you see, financial transactions depend on trust and liquidity. And
Yeah.
trust and liquidity are basically, kind of created by network
Mm.
externalities, right? And by basically establishing, once you have trust and liquidity, market power, right? So
Mm.
even in a world where there is no regulation, you will see that, let's say, in trading markets,
Yeah.
liquidity will go to a few in locations, because
Right.
liquidity begets liquidity, and then everybody wants to be there. So even if I don't give anyone market power
Mm.
exogenously, right, it will just happen by itself. And you
Yeah.
saw, it's actually cool to see, I mean,
Yeah.
it's not good for the world, but for me as a finance
Yeah.
professor, I was like, wow, this is so cool. Because what you saw in, say, even on Ethereum, right? On Ethereum, initially, there were a
Mm.
number of different decentralized exchanges like
Mm.
Uniswap and SushiSwap and many others. What happened very quickly over time, all the liquidity is basically in Uniswap, right? I mean, or in a
Yeah.
very few places, and there is no barriers to entry, right, on Ethereum. It's just this
Right.
liquidity externality. But now, right, you have a situation where you have a few players that
Mm.
have market power, but because everything is pseudonymous,
Yeah.
our ability to regulate them and to make sure that, say, they don't take advantage of the smaller investors or the ones that, don't have a lot of bargaining power and so on,
Yeah.
is actually even more curtailed. And so
So
therefore, right,
yeah.
it didn't lead to
Yeah.
this leveling of the playing field
Yeah. Yeah.
that was intended. And
It
I
was
will tell you, I
intended.
will
Yeah.
let you ask you a question, but keep in mind, I want to tell you something about the
Yeah.
centralization of mining power as well.
Yes. So we want to talk about concentration. I mean, the concentration all through the supply chain, let's call it. But I want to just touch on another paper. So are cryptos different, you say here? Evidence
Ah,
from retail trading. Trading in cryptocurrencies, you say, grew rapidly over the last decade,
mhm,
dominated by retail investors. Using data from eToro, we show that retail traders are contrarian in stocks and gold, yet the same traders follow a momentum-like strategy in cryptocurrencies. The differences are not explained by individual characteristics, investor composition, inattention, differences in fees, or preference for lottery-like assets. We conjecture that retail investors have a model where cryptocurrency price changes affect the likelihood of future widespread adoption, which leads them to further update their price expectations the same direction. Yeah, so we have something like this going on in artificial intelligence, right? As you
mhm,
know, uh, a lot of investors are confused.
mhm,
If AI gets widely adopted,
mhm,
the value of these companies are going to be exponentially higher.
absolutely.
But if we crash and burn, I think Nasdaq was down 2% today. I'm in that camp. Then things are going to go down. So this is one of those assets that. So I never invested, Antoinette, in any asset that I can understand.
Mhm,
Um, And this is one of those assets that um, derives its value from potential future adoption.
Yeah.
So that makes it very, very volatile, right? That's what's going on.
So it's a very good point. It's true, if you think about, right, the majority of cryptocurrencies have currently very little real cash flows that they're generating.
Yeah.
Right? So a lot of it is basically the value is in the appreciation of the tokens.
Or
If
expected appreciation.
the
Yeah.
expected appreciation of
Yeah.
the tokens in the future, if basically this became the predominant ledger that
Yes.
everybody had to use, right, to
Yeah.
make transactions. And so you're right that we do see that even now, when the valuation of, say, Bitcoin or Ethereum has, gone up so much from maybe where they were 10 years ago, also the depth of the trading and the amount of trading that happens on exchanges of those tokens, right, is very high. And normally what we see is when that happens to stocks, right, the more liquid a stock becomes and more people trade it, actually the volatility starts shrinking. Because,
Yeah.
right, the people that are negative or, pessimistic versus
Sort of
optimistic
balance
will
out, so
kind
to
of
speak.
exactly in
Yeah.
expectation already be there, and the price will be somewhat less volatile. That has actually not really happened with cryptocurrencies. And you're right. So the volatility is still very high. And we conjecture in this paper, where we actually have data on individual retail traders and how you right they are trading crypto. What we believe is that people have a very different view of what drives crypto prices versus other prices, and what of other securities. And what
Yeah.
is nice, we can actually see for the same person, right? We see
Yeah.
that person trading in stocks, trading in commodities, and trading in crypto. And what you see is for all the other asset classes, people
Yeah.
try to be market contrarian. So and we are not the first ones to show that. Actually, other
Yeah.
people have also shown this, right? That in all these other asset classes, what retail investors try to do is to say, when the price of stocks or of Tesla has gone up a lot,
Yeah.
probably it will mean revert. So I want to be
Right.
trade out of it before, and so they try contrarian. And
And
when
this
the
is
price has
exactly the
gone
different. It's exactly the
right,
different thing. Yeah.
right, it's exactly the opposite. And in
Yeah.
crypto, they tend to be basically buy and hold. So when the price goes up, they just keep on more holding, right?
Yeah. Yeah.
Instead of, in a way, taking some of the profits off the table. Now, we think it's exactly as you were saying before. It's because actually people are quite smart about what drives the value of crypto. They understand that if I don't have any cash flow signal, right? Because they
Yeah.
don't have cash flow signal. So what's the only signal I have? It's price. And
Right.
when the price goes up, maybe it's a sign that even more people are interested in this cryptocurrency, right?
Right.
So more people will adopt. Maybe the regulators will be nicer to that cryptocurrency too, right? And so more and more adoption should have basically a persistent then increase in the price of crypto. And of course the reverse when the price goes down, right? And that is
Yeah.
very different, say, from stocks and bonds and everything else.
Yeah. I mean, it's a bit like the gold rush in California,
Mm-hmm.
or a startup company for that matter. Um, Startup
So
company in AI, let me call it.
that's true. I mean, one
Yeah.
has to be a bit careful
Yeah.
because you see,
Yeah.
there are some things where, economists, we like to call it animal spirits, right? Where everybody is just goes crazy and thinks, oh my God, right? This thing is going to be so valuable.
Yeah.
And everybody is just too optimistic about certain maybe
Yeah.
technologies, right?
Yeah.
But actually, what at least our research on cryptocurrency trading of retail investors shows, it seems less that everybody is just crazy about it, right, and holds it all the time, but it's more that
Yeah.
they actually understand that there is this externality from when the price goes up, and therefore the likelihood of more people flowing into this market and
Yeah.
therefore adopting it more. It indeed then can increase the value of cryptocurrencies.
Yeah, so I mean, there is no close analog to it. If Einstein started a company when he came up with the general theory of relativity,
Mm-hmm.
it would be a bit like this in the sense that, we don't know if it's true, but if it's true, it's going to fundamentally change humanity.
Mm-hmm.
It's a bit like that, right? So, in that sense, it's just like a startup. Um,
Oh,
so,
absolutely.
yeah, yeah,
You mean, yeah, different cryptocurrencies are very much
yeah,
like a startup, right? In a way, what are they trying to do, right? They're trying to build an ecosystem where you offer a ledger to your customers. Now, a ledger is only valuable if people actually use it for transactions,
yeah,
right? Otherwise, there's a ledger, but who cares, right? So
yeah,
you need to basically, right? So the entrepreneurial game here is to build applications on the platform that
mm,
make it so that people want to use your platform, right? Either
yeah,
for trading, for taking, kind of taking out credit, flash loans, right? Or for maybe trading. Um, I mean, beyond
yeah,
trading coins, maybe even mm, trading other applications or
right,
using it for smart contract execution and so on, right? So,
mm,
so therefore, you can see that most of the big blockchains that you're aware of,
yeah,
including Ethereum, Bitcoin nowadays also does more of this. The same has been true, say, before it crashed for Terra Luna, right? The founders behind
yeah,
the cryptocurrency try to always actually incentivize developers to come
yeah,
to their platform and build applications on the platform, because it's
mm,
you right you need to solve, like, in a way, like Uber or Lyft, you need to
yeah,
solve a dual-sided market problem. You need to get users and you need
mm,
to get merchants to the platform so that you have a lot of potential users that will incentivize people who want to sell something on the platform. But the more
right,
interesting things you have to sell on the platform, right, the more users will come. And that's the kind of, if you want, marketplace liquidity that
yeah.
these cryptocurrency founders are trying to create.
So I want to go into the Terra Luna crash.
Oh, okay.
But before that, I want to sort of set the market context for this. So, you have another paper, blockchain analysis of the Bitcoin market.
Mhm.
Bitcoin being one of the cryptocurrency. You say here this paper presents a comprehensive analysis of the Bitcoin ecosystem using blockchain data from 2009 to 2025, examining transaction patterns, mining concentration, and ownership distribution. Our findings show that the Bitcoin network has become increasingly dominated by large, concentrated players,
Mhm.
contradicting its original decentralized vision. Whoever that guy, Japan or wherever he was from, the original decentralized vision is not working anymore. The top 50 miners control nearly 50% of network power, while the
Mhm.
top 0.01% of the individual investors hold approximately 25% of circulating supply. Exchange and trading related entities account for 70% of all blockchain activity. So, I mean, this is a highly, highly concentrated market,
Mhm.
maybe 10x compared to the stock market or something like that, or
Oh, yeah.
commodities
So,
market.
well, even like, say,
Yeah,
the wealth distribution in the US. Yes,
yeah.
absolutely. Hmm. That's
And
true.
so that, well, I mean, it gives it a different market dynamic. It's
Right.
really driven by a few players in
Yeah.
some ways, right? Yeah,
Yeah. And you see, we talked about this right before about
yeah,
the endogenous forces inside of how cryptocurrencies are designed that actually lead to this concentration. And
yeah,
what you can say, we point out, for example, that um, in Bitcoin, which is what is called a proof of work, right? So
yeah.
miners, which are the validators who validate transactions on the ledger, right, on the
Yeah.
blockchain,
So
they
what do you
need
mean
to.
by, sorry to interrupt, Antoinette. So
Yeah,
what do
go
you mean
ahead.
by proof of work? Are they creating a new Bitcoin or?
So
Not really.
they are,
Yeah.
so no, they do. I mean, so what happens is basically, in order to basically add another block to the blockchain, right? And inside of the block are all the new transactions that are, being recorded, say in this next 10 minutes or in these 10 minutes, right? So in order to be allowed to add this block to the blockchain, you have in this idealized world, you have multiple miners who are competing with each other to get the right to add this block to the blockchain. Why are they competing? Because if you manage to be the first to solve this hashing puzzle, right?
So
then
they both found the same Bitcoin.
So they haven't found a Bitcoin. What they find is there's a block with transactions that people, have wanted to do these transactions, and now they have to be recorded on the blockchain. Yeah. In order to give the miners incentive to want to do that, you need to pay them something. And what do you pay them? What you pay them is two things right now, which is the fees that the participants, right, who have transactions are willing to pay in order to have the block and their transaction enshrined in the block. Think about it a little bit. Whenever you do a wire transfer, you have to pay something to Bank of America for them to be willing to do the wire, right? I mean, you can say that. But that's actually the lesser of the money you get as a miner right now, because what happens right now is whenever you're the one who adds the block, you are given a Bitcoin. This is the design of the system, right? And at some point, it will stop and no more new coins will be issued. And then it will be only the fees that the participants are willing to pay is what the miners get. Yeah.
So that's another fascinating part of this, Antoinette. I would understand this. So Bitcoin, for instance, we can only have 21 million Bitcoins ever, right?
Well, and that's because the protocol has said that they want to stop at 21. Some people say, yes, good.
Can we change it in the future?
So, right now it's said you can never rule it out, because if if there is a dominating coalition of decision makers that indeed decides to change it, they could potentially change it. Now, of course, right, as an economist, you also understand, given how much reputational capital is built on the 21, imagine they do this, they very much risk that then people will say, oh, I trusted you so much, and now you break my trust, right? You will start inflating the system and creating more and more coins, right? Maybe that would actually really destabilize. So many people, who believe in, the robustness in particular of Bitcoin, right, feel that they will not start messing with that number. But you see, on the other side, what we have already started seeing is that in this idealized world of Satoshi Nakamoto, what was assumed is that there are thousands and thousands of small miners who compete against each other in this hashing game, and therefore an individual miner never has an incentive to do something shady or fraudulent, because they're so tiny, right, that the next block and the next validation will go to somebody else, and therefore there's never, right, in a way the system keeps them honest. But and this is why we wrote this paper, is that actually what we have already seen, even in the first 10 years of existence, right, is that the endogenous forces of efficiency push miners to become very big, and only a few miners have actually succeeded to be really big and dominate the playing field. Why is that? It's actually because ultimately there is a lot of fixed cost in being a good miner, right? You need to set up a mining rig. You need, you know how energy intensive mining is. So if you're somebody who has a better contract with the energy provider, or you're sitting, in Kazakhstan next to a, very cheap energy source, right? Or in the US, next to a very cheap energy source, you have a big advantage over somebody who tries to, plug into your, kind of network and pay the normal price. And so all these type of things naturally have kind of basically have led to this massive concentration of mining power. And once you have a lot of concentration of mining power, you need to, you have to start worrying about whether the blockchain becomes subject to attacks, right? Or collusion of some of the big miners. And that's something I do worry about a lot.
So two thoughts are going through my mind. One is, I understand that a very high concentration of mining in Russia. Is that true?
Actually, so that used to be true. You know what? That's not the case anymore. Actually, so what has happened over the last, it used to be, in particular, it used to be in China and in Russia as well. Now, over the China basically banned or made it illegal to do to basically trade in cryptocurrencies, but also to mine cryptocurrencies in China. And so a lot of miners left China. And in fact, what you now have actually is a lot of miners and also validators and are actually in the US. So there is now a lot of concentration of very big players in the US.
So things have changed a bit.
Yeah, exactly.
And the other thing is this 21 million limit. I'm just thinking about it from an engineering perspective. As you reach it, sort of asymptotically, the mechanics of the market will change, right? I mean, if there are no more things to be mined, well, I mean, if people believe in this asset, the prices would go up, I would imagine, right?
Well, I mean, if no more, so I think what the first thing that will have to change dramatically, right, is that as soon as no more Bitcoin are able to be mined, now the participants on the blockchain have to pay the full price of the transaction of having their transactions enshrined in the block. Because you can basically say that currently they're being cross-subsidized by all the people trading in cryptocurrencies or in Bitcoin who keep the price of Bitcoin high. And therefore, right, miners are very happy to mine and to compete and so on, not because of the little fees that the individuals pay here, but the big price of getting each time a Bitcoin, right? Once this goes away, then the people here will actually have to pay for the transactions. And so then you start already seeing that in a way, the participation game will start changing, because now, right, maybe what would happen is that people that have small transactions, I mean, that's actually already the case, right? Don't find it useful to use Bitcoin as a transaction platform, right? So then you might only have really big transactions where it's not so important whether you're paying $90 or $20 or $5, right? For a transaction.
Or illegal transactions.
So that's the other thing that you're bringing up, right? So which is basically, the other worry people have had, right, is of course that these kind of pseudonymous cryptocurrencies are being also used for illegal transactions. Now, I absolutely share that concern, because, we show even in our work that some of the worst dark markets where lots of horrible things are being traded, from guns to drugs to even people, using cryptocurrencies for payment. But we also show that, at least if you look currently, the majority of volume and transactions on the blockchain is actually for basically trading, gambling, and speculation, right? So in a way, that's actually where most of the volume is right now.
Okay. That's sort of comforting in some ways, because this is sort of set up in some ways, for criminals.
So I think this is still happening, right? But it's also, remember, as we were saying before, it is also true, because everything is pseudonymous. It is possible to trace addresses on the blockchain. The problem is more that when somebody sits or lives in a jurisdiction, right? Like, say you are in the US, you are being defrauded by somebody in a country, let's not pick on any country, but, a country on the other side of the world, you might even be able to trace the address, right? But you will, unless you're willing to invade that country, right? I mean, you will not be able, let's not get there, but, kind of...
we have a president who's willing to invade any country, so I think that's also comforting.
let's not get into politics. Crypto is hard enough. Politics is really not my forte. So, but all I'm saying is that a lot of, even if you can trace some addresses and flows, it doesn't mean that you can bring to justice the person or the entity that has defrauded you or that has somehow harmed you. For example, we show, right, that without, we show in our work that even kind of say American or European centralized exchanges like Coinbase and Kraken, and all the ones that actually do some KYC, know your customer, and anti-money laundering verification of their customers, they're still receiving a lot of tainted Bitcoin. Why? Because you see, it's almost impossible for them, right, to trace every Bitcoin that comes into Coinbase back.
It's in the pool, right? It gets pooled in some ways.
Yeah, right. Yeah. So they cannot trace it back all the way to, whether 5 transactions before there was some fraudulent thing, right? And so then, the even the tainted coin might go through many people's addresses and ultimately come to Coinbase. And then, as you say, right, once it's there, it's pooled, it's traded. And when somebody takes it out, it looks clean again, right? And so we really, you see, this is why in the traditional financial world, we spend so much actually effort, time, and ultimately resources, right, to make sure that every bank that an American bank, say, or European bank interacts with does KYC and AML verification, so that some money launderer, even sitting very far away from the US, right, doesn't use US banks as a way of, or some drug trader and whatever, right, to clean their money. Now, let's also not be naive, right? That's also not perfect in the traditional financial world, right? We know that many banks have been fined for not doing a great job on AML and KYC, so there are lots of failures there as well. But of course, now we opened up another can of worm that, where maybe we are making this even easier.
So I want to look at the crash. You say the anatomy of a run, the Terra Luna crash. It's very interesting. So you say you will examine the dramatic collapse of the Terra blockchain in May 2022. Using granular blockchain data, we analyze the mechanisms underlying the run and draw parallels to the traditional financial system. We show that the early success of Terra's algorithmic stablecoin, UST, was fueled by highly subsidized deposit rates, which attracted many investors but created a fragile system prone to run. So when these guys went in, if I understand this correctly, they were sort of providing incentives for investors to get into it.
Yeah, so, like you were saying, right, entrepreneurship. So when they started, Terra Luna, actually, in some sense, they were in a somewhat difficult competitive situation because Ethereum was already there, Bitcoin was already there, other cryptocurrencies. So they had to decide, how do I make my cryptocurrency special, right? And how do I stand out relative to other cryptocurrencies? And what did they do, which you can say actually was quite ingenious? They said, what is that the others don't have? They don't have what, is typically called a stable coin. What's a stable coin, right? A stable coin, think of it almost like, it's a means of payment that is pegged 1-to-1 to the dollar. And therefore, it is supposed to be indeed
and
stable,
right? They're going to keep the peg.
Exactly. And you want to keep the peg, right? Rather than crypto Bitcoin or Ethereum that goes up and down all the time, right? And Luna, which is the token, people call it the native token of Terra, was Luna. Similar what Bitcoin is for Bitcoin, right? And so then they said, look, let's now create a stable coin. Now, the other thing they said, in order to be special, right, is they said, we will do a stable coin that doesn't depend on external collateral. Because, right, normally when you try to do a stable coin in order to keep it pegged to the dollar, Tether or Circle, right? Some of your favorite stable coins might be, right? What do they do? What they do is they say, for every dollar of stable coin I issue, I promise my customers, I put $1 of money into a bank so that there is a backing, right? A collateral against this virtual money that I'm
And they
issuing.
did that, or they were just
No,
saying
so
it?
that's what the more traditional players do, like Circle or Tether and so on, right? What these guys said is that, but look, when you do what Circle or Tether does, you're still very dependent on the traditional financial system because you need to rely on banks to keep the collateral, right,
To keep the
safe and in the
dollars,
bank, right?
Yeah.
So what they said, let's find a way of being, in a way of living entirely in the crypto ecosystem. And so what did they do, right? What they did is they said, we issue the stablecoin, US, they called it UST, and it's pegged one against the dollar. But how does it keep its value? It keeps its value because at any point in time, an investor or a person who holds UST can swap it into Luna. So it's actually backed by the value of Luna. Yeah. And so the idea had been, as long as the market and investors believe in the value of Luna, the market or the value of UST should always be pegged to the dollar because right, there is a swapping mechanism. Imagine UST was above a dollar. What can a smart arbitrager do? They can say, let me sell short a UST,
Short UST,
exactly, convert it into Luna, and then I get more than $1. But by doing this, I bring Luna back to its peg. Sorry, not Luna, UST back to its peg and Luna up, right? And the other way around if it's below. So that was what they wanted to do. And now what you were saying about the incentives, what they, on top of it, they said, okay, so we have this nice idea, but we want people to try out, if you want, UST, right? And use it. How can we incentivize to use it? What they, on top of it did, they said, the system then provided people who held UST with an opportunity to deposit their UST into, something that looked like, you can think of it like a money market fund, right? But basically into a protocol called Anchor. And they are actually the Terra, Luna, the founders and through the community wallets, but basically they provided subsidized interest rate to the holders of UST. And you should understand the subsidy was really, really high because they somewhat arbitrarily decided that the subsidy would be 19%. And this was at a time when, say, on similar protocols for Ethereum, right, or basically other, of these stablecoin protocols, you would maybe get 2% or 3%, right? So it was really a huge subsidy. And so in some sense, it did attract a lot of investors to come to Terra Luna.
Yeah, I wish I knew this. I would have gone it myself.
No, you don't. You don't. You wish you knew it if you had sold it before the crash, right? That's what everybody always says. You wish you knew it.
That's right. Yeah, I always take subsidies in capital markets.
Correct.
So this is one of those things that sort of set up to fail in some ways, in the sense that, well, let me make a statement and you can object to it.
Yeah.
If it sort of went medium level, maybe it had a higher longevity, perhaps.
Yeah.
If it actually taken off, by definition, it's going to fail because you're going to run out of money. I think is that what happened to these guys?
So that's interesting. I would say I would agree with you, but the mechanism is slightly different. So I think what happened to these guys, and I don't know, and I have no stake in this, but So I think the big mistake was the following. When Terra started taking off, and Terra Luna starting, meaning the value of Luna started going up, they were willing to issue more and more UST against the value of Luna. Yeah. And of course, maybe even initially the idea was, okay, great. There will be more UST, there will be more users, and at some point, people should actually use the UST for things that are value creating and therefore create fees, right, on the Terra ecosystem, exactly what we discussed about Bitcoin, so that then fees are generated that justify the high valuation of Luna. Yeah. But that never happened. So in our research, we show the only thing that happened is people came to the platform, but not to, in a way, pay for transactions and pay for things that made profit for Terra Luna. No, they came, like you said, to take out the subsidy via UST and the Anchor protocol. And so that, of course, you're right. Once the founders realized that, look, all that's happening here is people are coming to extract the subsidies, but nothing else is being created. They should have said, wait, pause, right? And let's really kind of reconfigure this so that the whole thing, doesn't collapse. Or maybe they should have said.
And they were fickle investors in some sense because they're looking for tactical money, right? In some ways.
Right. I mean, you see, the thing, I think what they at some point then decided is either we go hop or flop, or what is it called? Kind of, you basically either go out really high and you gamble, right, for some really high price, but you're also willing to let it collapse if, just no fees are being generated in the end. And I think, maybe you can say that's how this system was allowed to be set up to fail. And, the truth is that what really happened, or who really got hurt, were all the small investors who we also showed this in our research, right? Who were very slow to pull out once the system started failing, while the
big guys pulled out faster.
Absolutely, right? And we can even show that the big guys, the big wallets monitored each other on the blockchain. And so once a few big wallets withdrew millions of dollars, the other big wallets very quickly started running.
Because they could see it, right? They could see
right? That's also why people say, oh, look how great the blockchain, right? Because you can see each other's transaction. In a bank, you can normally not see that, right? The bank knows that some people are running, but typically the bank has no incentives to tell people that some people are running, right? I mean, because then you make the run worse. But here, right, it's true that theoretically everybody could have seen that the run is starting. But what we show in our work, right, and maybe not surprisingly, but it's the large and very sophisticated traders who indeed monitored each other. And as soon as some of the very big guys run, the others follow. The small guys actually did run way, way slower. And they run basically only after the price has already dropped significantly. And therefore, they are the ones who are bearing the really big losses. Yeah.
I mean, do you think we have the same problem in conventional stock markets? We have very large hedge funds. We have very large investment banks. I don't know what the concentration is, but it's probably less than the cryptocurrency concentration. But it's still fairly highly concentrated.
Yeah.
And when there is some sort of hype, and we call the artificial intelligence a hype. I'm making a statement. You can object to it. The big guys go in, the big bunch of money, and then when the big guys get out, the small guys cannot, because there's no liquidity in some way. So I saw something in Nasdaq today, people saying, "Get me out," to the brokers. So I cannot get you out because I can sell you a stock. I think we are heading towards some sort of disasters. Making a prediction about the future is always injurious to health. But I see signs that things are heading in that direction. What do you think?
Yeah, remember, I'm an economist who really doesn't like to make predictions. Let me say two things. So before I make a prediction, and I promise I will not completely punt on on your attempt to make me do a prediction, but so I think you're right? That in the stock market, it's also true that often the smart investors obviously make way more money than the dumb investors. That's why even, we typically don't call them dumb investors. We call them in finance models, noise traders and
And
informed
we
investors.
have 20, as you know, we have 20 million day traders
Yeah,
in the
absolutely.
US stock markets.
But I also not all day traders are stupid, but
Yeah,
that's right. That's all fine, right? But
yeah,
I think the big difference. So there's two things, right? It's true that in the stock market, the more informed investors do better than the uninformed. But that's
yeah,
why, for example, right, in the traditional financial system, we for more like 20, 30 years now, right, we have this in a way the attempt to provide the small investors with investment vehicles that allow them to be smarter, so that, for example, they
yeah.
have access to mutual funds or to index funds, right? So basically
Or ETFs.
ways,
I mean,
and
ETFs are the best.
ETFs, right? So that they're at least already diversified, that they're
Yeah,
not taking the craziest risk and so on, right? And so there's some of that. I want to say, but UST is it's closer to a bank than to the stock market, because it's right, it's like a demand deposit where you put
yeah,
money in, and it was supposed to be pegged one on one against the dollar, and you were
yeah,
not even right. These people that were holding UST, yes, they were trying to get the 90%, they were not trying to speculate. I mean, they were hoping that it would just be, kind
mm,
of a $1 that they would ultimately get back when they withdraw the UST. But then
yeah,
what happened? You basically had a run on Anchor and a run on Terra that then
mm,
destroyed the value. That's more like, having a run on a bank in the US. And so you
yeah,
see the difference here is that, again, the reason why we have all this expensive and often cumbersome regulation of banks is because we want to avoid these type of
mm,
runs, right? That's why we have the Fed as
yeah,
last resort. That's why we force
mm,
traditional banks to hold capital so that, kind of they don't take the craziest risk. And as soon as there is some rumor, right, everything collapses and so on. And so you see, this is why ultimately in my research, what has often been to me somehow, as a financial economist, very sad, is that a lot of built-in mistakes in
yeah,
how institutions are built on the crypto in the crypto ecosystem seem to
yeah,
ignore decades, if not 100 and more years of research in finance that already
yeah,
can tell you this cannot work. And I always
right.
feel like, of course, you hate to be this old lady that says, I told you so. But very often I feel, look, if you people just took finance a bit more serious, you could have avoided so much pain, so much losses, right? Because to be honest, Terra Luna was a horrible shock in Asia in particular. Americans did not invest as much in Terra, but especially say in South Korea and other places in Southeast Asia, some people
Mm,
lost their entire life savings in
yeah,
that thing,
yeah,
right? And there were people suicides and what have you. So,
mm,
it is, this is the thing that worries me the most, that we are, in a way, we opening up a space of, very unregulated finance where people that are uninformed can really hurt themselves by participating.
yeah. I mean, the message here is that it's not easy to make easy money.
That is a nice phrase, yes.
And it's also true. I mean, financial markets is very clear. It's also true in real markets. We have a guy going around creating robots, and he's saying that nobody goes to medical school anymore because my robots are going to be your doctors. I'm not going to allow that thing to take my appendix out. I'll tell you right
Mhm.
now. And so it also happens in real markets where people get too far ahead of themselves, right? So I don't know what the right solution is. Perhaps it's education. I mean, you're an education institution. What we have to teach kids is not how to make money, but how to rationally analyze data, right?
Absolutely.
And I think we're missing a trick a little bit. I think. What do you think?
So, I mean, obviously it is very self-serving as someone at a university to say that education is really important. But, I mean, I think that's kind of almost a tautology. But I agree with you that we need to teach people, number one, I think, to be much more critical of the type of stuff that comes out of certain, kind of out of markets, out of your chat GTP, out of everything. And so I think what actually has happened is that I personally actually think that these new technologies can have really positive effects for society too, because it can indeed make us all more productive, maybe even allow us to not just productive, but maybe even more creative. Because to be honest, a chat GTP or what, any kind of, LLM or AI has access to more knowledge than anyone's individual brain. And
More
therefore, right,
historical. The thing there is a more historical knowledge. The fundamental question I think some people are asking is, we could not have gotten Newton or Einstein or Maxwell by reading historical texts. And that's where I think we have a little bit of an issue from a creativity perspective, I think. I don't know. I mean, I'm just speculating.
So I would say the following, that's where I wanted to go, which is if people really learn to use these tools really just as an input into their own creativity, I think it can be really great. What I'm very worried about, even as an educator, I start seeing is somehow that people start outsourcing the thinking to that thing.
Yes.
And so, but that's my main concern, because then if students and everyone forgets or does not get trained from the beginning to really critically think of how to make sense of the world, how to make sense of, even very beautifully polished reports that come out of ChatGTP, right? Just because they look beautiful doesn't mean that they're right or that they are telling you anything meaningful, right? They're just nicely done, but nicely done is vacuous too. And that's my worry, right? That we are kind of going into this world where instead of using it as a way to actually, if you want, right, actually
as a tool, as a
make
tool
it
to
hard.
improve you.
Right. But I think people really need to understand that if anything, it actually really increases the demands on us to provide more critical thinking, to provide basically, right?
That's the right way to use it. But I don't know if did you see that MIT study that your institution that put out something that said if you continue to use ChatGPT, your brain rots?
That is, if you use it in the wrong way, yes.
I truly believe. I mean, the problem with young kids, as when they find something that is sort of giving them answers, they'll continue to use it. And it's a bit of a problematic outcome in the sense that, I mean, as you know, all universities have stopped using essays for admissions for good reasons.
Absolutely.
So we are heading in a direction. I mean, there's two possible outcomes here, I think. One is to say, here's a tool that I could use to make myself better. The other outcome is, here's a tool that I can find some time on, just automate things for me. The latter outcome, I think, is very problematic. What do you think?
Agree. I agree. I mean, in particular, it's problematic to me. I mean, or the challenge to me is that we still don't fully we don't fully understand at all how the human brain develops higher cognitive functions, critical thinking, and so on. So right now, we're seeing still generations of students that when they were really young, they didn't have access to ChatGPT, right? It's only becoming now a tool that they can use, but their brains are already formed. What we don't know is, right, if somebody is 5 years old and starts basically using, these out in a way that is able to outsource thinking to a system like that, will they be able to, or will we be able to find a way of teaching students so that, in fact, it enhances their critical thinking and not just supersedes it, right? And that's really what I think education in the next, decade for sure will have to solve.
Yeah, so we have to redesign education, I think. I'll make a statement, make an object to it. So the redesign of education is that um, don't store a lot of, let me make a grand statement. Don't store a lot of data in your brain because ChatGPT gives you all the history. So I don't have to, I don't need to store anything what happened in 1962. I mean, it's right there on the internet. What I need to think about is to put all my, I don't know how many billions of neurons there are to look forward, right? Is looking forward is where the power is going to be. It's not historical storing information and regurgitating data. I mean, we got technology to do that now. And so education have to, I mean, I often ask, why do we teach kids Newtonian mechanics? It doesn't work. And so, physics 101 should not be Newtonian mechanics. It has to be quantum mechanics. It has to be things like stuff that we don't understand. And that will develop their brain a lot faster than, you know, F equal to MA or whatever. We got computers to do that, right?
Yeah.
So in your field, in economics, so how do you think about this in economics more generally?
So, I mean, so I would say two things. For research and economics, I think, what we are starting to see actually are lots of applications where, say, LLMs and say, for example, LLMs are now being used, very creatively to access and process and classify completely new types of information into data, things that in the past we could have never thought about using, but are very useful, right? And so just to give you a very simple application, right? But it's true that in the past, in finance, we often thought about there's hard information, numbers, and then there's soft information, things where, let's say you need to meet with a loan officer so that the loan officer can understand if you're a nice person or an honest person or not, right? Will you default or not? Are you an organized person or not? And we thought, no data set can ever capture this. Now, right, we start having data sets that basically look at who are your friends? How do you manage, your day-to-day life? Does your home look organized, right? And stuff like that.
Yeah.
And it's actually
sort of a
useful.
quantitative personality test.
Absolutely, right? And even a quantitative way of capturing how you behave and how you come across, if you want, which before it needed a human to meet with you and see it. Now even data, right? I mean, large scale data sources can be used for this. Why is that useful? Actually, it's useful because we can now change the cost of providing lending to people maybe who have less hard information, but a lot of soft information, right? And so it changes the market structure, but with it, it has also changed the research because financial institutions are using these type of applications more and more. People, I mean, in finance research are, obviously analyzing how good is this, where are the limits of it, even maybe what type of biases will be created when using these type of new data sources and so on, right? So it's really opening up a lot of interesting ways to capture more of the world.
Yeah. I have to let you go, Antoinette. I took too much of your time. But I want to touch on one more thing. So it also has a downside in the sense that, there is the insurance company in New York that found with machine learning that African Americans requires less care.
Yeah.
And so if you sort of rely on historical data, we're going to make bad decisions.
That's right.
And it is in some ways societally very problematic, right? I mean,
I agree.
I don't think there's any solution. Yeah, go ahead. Yeah.
I mean, I hope there's a solution, and the solution is that, it still needs human decision making. So if we see that an algorithm is actually creating these very unequal outcomes for certain groups or certain people, right? All the tools we have normally in society And yes, they don't always work perfectly, right? But we need to use them. We can't just say, oh, because it's an LLM, we cannot actually put constraints on financial institutions to say that you are not allowed to discriminate, or you're not allowed to give disparate care to just because somebody is minority group or different gender or what have you, right? I mean, so this is still very, very important. And I just want to say, can I just say, I like to make this pitch because I completely share your concern, but I also want to say that people are also racist. People are also sexist, right? So we had to.
Yeah, computers might be less so, actually.
Exactly. What I was going to say is like, what goes on in somebody's brain is actually harder to observe and therefore often harder to regulate than an algorithm. And therefore, if we're willing to make sure that we monitor and audit and regulate these financial institutions well, it can be really a force for good. But it is true that it needs society's consensus and society's willingness to do that. And that's why I find it a bit worrisome that very often we now have this like, let the algorithms do whatever they want, right? And basically not think about how to get the best outcome for our society, right? We ultimately, we don't need these algorithms for the algorithm's sakes. We need them to make our lives better, right?
Yes, I was a bit close to this, Antoinette. So, yeah, I think that's a really important point, which is humans are biased. Humans are terribly biased entities. Perhaps we are moving into computers, artificial intelligence, what we want to call them. They might be less biased potentially. So we might be able to use them in a more optimized societal sense. I don't quite believe it yet, but I'm just putting this forward. Yeah.
I agree with you.
Excellent.
Let's hope that kind of we can use these technologies for good. Indeed.
You can. I mean, we have. I mean, so many beautiful technologies that we could be used in both ways. So I think that's the ultimate thing, which is, can we take this beautiful technology that emerged last 10 years? Can we use it for humanity's better purposes? That part is still unclear, but I think we can do it, possibly. Part of it is education, I think. I think universities have to really redesign their education content. But we'll leave to another podcast.
Exactly.
Excellent. Thanks, Antoinette. Yeah, thanks for
Thank you
spending
so
time
much
with me.
for the conversation. Take care.
Thank you.
Bye,
Bye.
Jill.